Hello, I'm Jason Hawkins, founder and president of Lightpath Wealth Advisors. At Lightpath, our goal is to provide education and guidance through life's financial journey and help you eliminate much of the noise that exists in today's complex financial marketplace. In today's topic, we're going to talk about mutual funds. We'll look at some of the misconceptions and dated philosophies that exist with these widely held financial instruments. For most of us, when we entered the workforce and started earning a decent income, we were encouraged to start saving for retirement, whether that be in a 401k, IRA, or Roth IRA. And for most of us, we were given the option of investing in a number of different mutual funds. Now, everyone's investment needs are unique, and there's certainly a time when mutual funds might be an appropriate investment tool. But the point I want to convey to our viewers is that we as individual investors have placed a significant amount of trust in this investment vehicle. And for many of us, we don't really understand what we are invested in and what the potential exposure is in our portfolio if we experience a market correction. Yes, mutual funds provide individuals the opportunity to own a diversified mixture of stocks under professional management. But when you look at mutual funds with a critical eye, you begin to discover that they have drawbacks that are important for you to be aware of. The most important fact about mutual funds is they're not insured against losses. They're vulnerable just like any equity. And although the drawdown risk can be recoverable for a younger investor, it can be devastating for someone that's about to retire or in the retirement stage of their life. Time is our most precious commodity, but sometimes time can be your friend or your foe. Let me show you an example of the volatility that has been prevalent in the S&P 500 since 1980. There's no question we've had tremendous market rallies during this period of time, but we've had some of the worst drawbacks in stock market history as well, most notably the financial crisis in 2008. But as you can see in this chart, the downturn in 2008 isn't alone. 5 of the last 30 years have seen intra-year declines that have exceeded 28%. Now, long-term investors are fortunate. The market has bounced back over time. But for some of us, we don't have the luxury of time. The point that I'm trying to convey is seeing your portfolio drop by 25% or more is a more prevalent occurrence than you might think. And mutual funds are not immune. These downturns can not only be emotional, but under the right circumstance can significantly impact when you retire as well as your retirement lifestyle. Tell me if this is you. In your retirement account, you've been provided a list of funds to choose from. You make your asset allocations, you get a bunch of stuff in the mail that you never look at, and get quarterly statements with a bunch of numbers that don't make much sense. Does this sound familiar? Well, chances are you're invested in mutual funds, but what you might not be aware of are the fees and loads you incur that eat away at your returns. All mutual funds have fees. A traditional mutual fund could contain anywhere from 10 to 20 fees, ranging from transactional costs to marketing and management expenses, as well as tax costs. In some instances, these fees can add up to over 2.5% of your investment account. Now, that may not seem like a lot of money, but when you start doing the math on the impact of fees over a longer duration of time, you realize they could cost hundreds of thousands of dollars over the lifetime of your investments. On top of that, depending upon what type of mutual fund you purchase, you have the potential to pay upfront loads and sales fees between 3 to 8%. That's money you're giving away without anything in return. Depending on what these fees add up to, they can create a headwind that make it very difficult to gain ground and perform to the financial benchmarks that you're striving for. And the scary part is we have to pay these fees no matter how well a fund performs, which is a whole nother topic. So do your best to be informed. So speaking of performance, it's important to understand that mutual funds are as much a marketing vehicle as an investment vehicle. Any fund can take a specific period of time and advertise that they beat their index benchmarks. But if you look over a longer-term investment horizon, you'll find out that those claims are a little misleading. Case in point, over the last 10 years, 82% of large cap and 88% of small cap mutual fund managers underperformed their index benchmarks on a relative basis. That's right, you're actually paying more for underperformance, particularly among actively traded funds. There's several inherent reasons for this, whether it be asset bloat, over-diversification, over-trading, tax inefficiencies, and yes, fees. The more you pay in taxes and fees, the less you'll ultimately gain from your investments. And when your funds are underperforming, that doesn't leave much money on the table for you. So if you feel like your portfolio isn't gaining the momentum you were expecting, or you simply need a guiding hand in getting on the right financial path, you're not alone. And Lightpath Wealth Advisors would be happy to answer any questions you might have. Reach out to us at solutions@lightpathwealth.com and feel free to schedule an appointment for a free evaluation. I want to thank you for taking time to watch this video. And if you're a first-time visitor, please take a moment to subscribe to our YouTube channel or visit our website to opt in to our email list to receive recurring educational materials and commentaries similar to this. Until next time, this is Jason Hawkins at Lightpath Wealth Advisors, where we help you navigate the retirement journey together.